Hello friends, in this video we are going to discuss everything about bank and its system, which is very important part in our day-to-day life and as per competition exams. In this video we will see the 5 most important topic related to banking system in India. First topic is evolution of banking system in India. Second is structure of banking system. Third topic is what are the different types of bank present in India. The fourth topic is services offered by the bank or the functionalities of the bank. And the fifth topic is the types of accounts that bank offer to its customers. So let's begin with the first topic, that is the evolution of banking system in India. The Indian banking system consists of commercial banks, which may be public, scheduled or non-scheduled, private, regional, rural and cooperative banks. The banking system in India defines banking through the Banking Companies Act of 1949. Now we are going to discuss the 3 different phases of banking evolution. In phase 1, that is pre-independence phase, which is before 1947, and phase 2 is from 1947 to 1991, and last is phase 3, that is from 1991 and beyond. Phase 1, the pre-independence phase. There were almost 600 banks present in India before independence. The first bank to be established, the Bank of Hindustan, was founded in 1770 in Kolkata. It closed down in 1832. The Oath Commercial Bank was India's first commercial bank in the history of evolution of banking in India. A few other banks that were established in the 19th century, such as Allahabad Bank, Punjab National Bank, and they have survived the test of time and exist even today. Some other banks like the Bank of Bengal, Bank of Madras and Bank of Bombay, established in the early to mid 1800s, were merged as one to become the Imperial Bank, which later became the State Bank of India. Phase 2, the post-independence phase. After independence, the evolution of banking system in India continued pretty much the same as before. In 1969, the Government of India decided to nationalize the banks under the Banking Regulation Act of 1949. A total of 14 banks were nationalized, including the Reserve Bank of India, that is RBI. In 1975, the Government of India recognized that several groups were financially excluded. Between 1982 and 1990, it created a banking institutions which specialized functions in line with the evolution of financial services in India, and they are NABARD, Exim, National Housing Board and SIDBI. Phase 3, the LPG Era. From 1991 onwards, there was a sea change in the Indian economy. The government invited private investors to invest in India. 10 private banks were approved by the RBI. A few prominent names where exist even today from this liberalization are SDFC, Axis Bank, ICICI, DCB and IndusInd Bank. The year early to mid 2000, 2 other banks, that is Kotak Mahindra Bank and Yes Bank, received their licenses. IDFC and Bandhan banks were also given licenses in 2013 to 14. Other notable changes and developments during this era are foreign banks like Citibank, HSBC and Bank of America set up branches in India. The nationalization of banks came to a standstill. RBI and the government treated public and private sector banks equally. Payment banks came into existence. Small finance banks were permitted to set up their branches throughout the India. Banks began to digitalize transactions and various other related banking operations. Now we will see the reasons why banks were nationalized in India. To get the clear picture of the impact of nationalization on the banking industry and the general population, let's understand why the government decided to nationalize the banks. To energize the priority sectors, banks were collapsing at the fast rate. 361 banks failed between 1947 and 1955, which converts to about 40 banks a year. Customers lost their deposits with no chance of recovering them. Next, a neglected agricultural sector. Banks favored large industries and businesses and neglected the rural sectors. Nationalization came with a pledge to support the agricultural sector. Next, expansion of branches. Nationalization facilitated the opening of new branches to ensure maximum coverage of banks throughout the country. Mobilization of savings. Nationalizing the banks would allow people more access to banks and encourage them to save, injecting additional revenue into the cash-strapped economy. Economic and political factors. The two wars in 1962 and 1965 put a tremendous burden on the economy. The nationalization of the Indian banks would give the economy a boost through increased deposits. Now we will see the positive effect of nationalization. The nationalization of Indian banks was one of the most significant events in the evolution of banks in India. After the nationalization, there was a 19 nationalized banks. Here are few ways that nationalization benefited the economy. First is increased savings. There was a sharp increase in the saving with the opening of new branches as national income rose in 1970s. Gross domestic saving almost doubled. Next, improved efficiency. The efficiency of banks improved with the additional accountability. It also increased the public confidence. Next, empowering SSI. Small-scale industry received a boost resulting in a proportionate improvement in the economy. Next, financial inclusion. The overall statistics of the banking sector and the Indian economy showed a marked improvement. It reflects on parameters like a share of bank deposits to GDP, the gross saving rate, the share of advances to DGP, and the gross investment rate from 1969 to 1991. Next, better outreach. Banks were now no longer only restricted to metropolitan areas. Branches were open in the remotest corners of the country. Next, a surge in public deposits. The increased reach of bank helped small industries, agriculture and the export sector grow. This growth was accompanied by a proportionate increase in public deposits. Next, elevating the Green Revolution. The Green Revolution, one of the biggest priority items on the government agenda, received a boost thanks to support that the newly nationalized bank provided to the agricultural sector. Now let's see some of the banks which was established before the independence, and these are Allahabad Bank, found in 1865, Punjab National Bank, found in 1894, Bank of India, found in 1906, Canara Bank, found in 1906, Bank of Baroda, found in 1908, and Central Bank of India, which is found in 1911. Now let's see the structure and hierarchy of Indian banking system. The Reserve Bank of India, India's central banking authority, was established in April 1935 but was nationalized on 1st January 1949 under the terms of the Reserve Bank of India. In 1949, the Banking Regulation Act was enacted, which empowered the Reserve Bank of India to regulate, control, and inspect the banks in India. The Banking Regulation Acts also provided that no new bank or branch of an existing bank could be opened without a license from the RBI, and no two banks could have a common directors. Now, under the RBI, what is the commercial bank mean? The term commercial bank refers to the both scheduled and non-scheduled commercial banks regulated under the Banking Regulation Act 1949. As per the Reserve Bank of India Act 1934, banks in India are classified into scheduled banks and non-scheduled banks. Now let's see the scheduled banks. By the definition, any bank which is listed in second schedule of the Reserve Bank of India Act in 1934 is considered a scheduled bank. The list includes State Bank of India and its subsidiaries like State Bank of Travancore, all nationalized bank like Bank of Baroda, Bank of India, etc., other public sector banks, regional rural banks, foreign banks like HSBC Holdings, Citibank, etc. Now let's see the scheduled cooperative banks, both classified as state cooperative banks and private cooperative banks. Private sector banks both classified as old like Karur Vysya Bank and HDFC Bank. To qualify as a scheduled bank, the paid up capital and collected funds of the bank must not be less than 5 lakh. Scheduled banks are eligible for loans from the Reserve Bank of India at bank rate and are given a membership to clearing houses. Now, a non-scheduled bank. Non-scheduled banks by definition are those which are not listed in second schedule of the RBI Act 1934. Banks with reserve capital of less than 5 lakh rupees qualify as a non-scheduled banks. Unlike scheduled banks, they are not entitled to borrow from the RBI from normal banking purpose except in emergency or abnormal circumstances. Jammu and Kashmir Bank is an example of non-scheduled commercial bank. Now let's see the different categories of the banks. As we wind down our discussion on the evolution of Indian banking system, we should touch upon the types of banks that exist in India today. Here are the major categories of the banks that you are likely to come across. First is public sector banks. The government holds the majority of shares of the public sector bank. A prime example is a State Bank of India, with 58.6% of its shares allocated to the Government of India. We could also consider the Punjab National Bank, of which the government holds the stake of 58.87%. Public sector banks are further divided into nationalized banks and state banks and their associate organizations. With nationalized banks, the government has a complete control and regulates the bank in all respects. But the government also has the option to sell shares of these banks. When this happens, the government's stakes are reduced. Sometimes the government becomes a minority in such banks, and then that bank gets listed on the Indian stock market. Second is the private sector banks. Private sector banks are owned by the private entities. They came into prominence in the 1990s due to the high quality service that they offer. These banks present the steep competition to the public sector banks. Some of the examples of these banks are Axis Banks, ICICI Banks, etc. Third is a small finance banks. Some banks in India provide a basic services like deposits, lending, and bank transfers. These are small finance banks and cater to the part of the economy that isn't being serviced by the regular banks, such as marginal farmers, small industries, and other parts of the uncategorized sectors. Examples of these banks are Ujjivan Finance Services Private Limited in Bangalore and Equitas Holding Private Limited in Chennai. Fourth, payment banks in India. Payment banks are the new model created by the RBI. These banks can accept restricted deposit but are not authorized to issue loans or credit cards. They offer both current and saving accounts and can also issue ATM cards or a debit cards. An example of a payment bank in India is Airtel Payment Bank, set up by Bharti Airtel. Such banks also have the major role to play in the evolution of e-banking in India, as they offer online payment solutions like mobile payment apps. So, this is all about the evolution of Indian banking system and the different types of bank present in India. Now, the next topic is services offered by the bank to their customers. There are total 18 services offered by the bank, and these are: first, advancing of loans. Banks are profit oriented business organizations, so they have advance loans to public and generate interest from them as a profit. After keeping certain cash reserves, bank provides short term, medium term and long term loans to nearby borrowers. Second is overdraft. Sometimes the bank provides overdraft facilities to its customers, through which they are allowed to withdraw more than their deposits. Interest is charged from the customers on the overdrawn amount. Bank overdraft is different from the cash credit. Third is the discounting of bills of exchange. Discounting of bills of exchange is another popular type of lending by modern banks. Through this method, a holder of a bill of exchange can get its discounted by the bank. In the bill of exchange, the debtor accepts the bill drawn upon him by the creditor, that is, the holder of a bill, and agrees to pay the amount of mention on maturity. After making some marginal deductions in the form of commission, the bank pays a bill value to the holder. When the bill of exchange matures, the bank gets its payment from the party which had accepted the bill. Fourth, check payment. Bank provides check pads to account holders. Account holder can draw check from the bank to pay money. Banks pay for the check to customers after formal verification official procedures. 5. Collection and payment of credit instruments. Different credit instruments such as the bill of exchange, promissory notes, checks, etc. are used in modern business. Banks deal with such instruments. Modern banks collect and pay different types of credit instruments as the representative of customers. 6. Foreign currency exchange. Bank deals with foreign currencies as per customer requirements. Bank exchange foreign currencies with local currencies, which is essential to settle down dues in the international trade. 7. Consultancy. Modern commercial banks are large organizations in the functions. Banks hire financial, legal, and market experts who advise customers regarding investments, industry, trade, income tax, etc. They can expand their functions to consultancy business. However, for several reasons, bank needs to disclose customers' information to the government and regulatory authorities. 8th, bank guarantee. Customers provided the facility of bank guarantees by modern commercial banks. When customers have to deposit certain funds in governmental offices or courts for the specific purpose, a bank can present itself as a guarantor for the customers instead of depositing funds by the customers. 9th, remittance of funds. Banks helps their customers in transferring funds from one place to another through the checks, drafts, etc. 10th, credit cards. A credit card is a card that allows its holders to make purchase of goods and services in exchange for the credit card's provider immediately, paying for the goods and services. The cardholder promises to pay back the purchase amount to the card provider over some time and with interest. 11th, ATM services. ATM replace human bank tellers in performing giving banking functions such as deposits, withdrawals, and account enquiries. Key advantages of ATMs include 24-hour availability, elimination of labor cost, and convenience of location. 12th, debit cards. Debit cards are used to withdraw funds from cardholders' accounts electronically. Most debit cards require a personal identification number to be used to verify the transactions. 13. Home banking. Home banking is the process of completing the financial transaction from one home instead of utilizing the bank branch. It includes making accounts inquiries, transferring money, paying bills, applying for loans, and directing deposits. 14th, online banking. Bank offer online banking that allows account holders to access their accounts data via internet. Online banking is also known as internet banking or web banking. Online banking through traditional bank enables customer to perform all routine transactions such as account transfer, balance inquiries, bill payments, and stop payment request. Some even offer online loans and credit card applications. Account information can be accessed anytime, day or night, and can be done from anywhere. 15. Mobile banking. Mobile banking is a term used for performing balance check, account transaction, payments, credit applications, and another banking transactions through the mobile device, such as a mobile phone or a personal digital assistant, that is PDA. 16. Accepting deposits. Accepting deposits from savers or account holder is the primary function of a bank. Bank receives deposit from those who can save money but cannot utilize it in a profitable sectors. People prefer to deposit their savings in a bank because by doing so they earn the interest. 17. Priority banking. Priority banking can include several various services, but some popular ones include free checking, online bill pay, financial consultation, and information. 18. Private banking. Personalized financial and banking services are traditionally offered to a bank digital high net worth individual for wealth management purposes, and they have acquired far more wealth than the average person and therefore have the means to access a large variety of conventional and alternative investments. Private banks aims to match such individuals with the most appropriate options. So, these all are the services offered by the bank to its customers. Let's see the different types of account exist in a bank. First is saving account. As the name suggests, the saving accounts can be opened by an individual or jointly by two people with the aim to save the money. The main benefit of opening saving bank account is that the bank pays you an interest for opening the type of account with them. There is no limit to the number of times the account holder can deposit money in this account, but there is a restriction on the number of times money can be withdrawn from this account. The rate of interest that an account holder gets varies from 4% to 6% per annum. The saving account holders can get an ATM, debit card or RuPay card if they want to. Second is current account. These accounts are not used for the purpose of saving. This type of accounts is mostly opened by businessmen, associates, institutions, companies, religious institutions, and other business related works. There is no fixed number of times that money can either be deposited or withdrawn from such accounts. There is no interest that is paid on such accounts. Next is recurring deposit accounts. Recurring deposit accounts or RD account is form of account wherein the account holder needs to deposit a fixed amount every month until it reaches the fixed maturity date. Any individual or institution can open a recurring deposit account either separately or jointly. Periodic or monthly installments that need to be added can be as low as 50 rupees or may vary from bank to bank. The range of months for which the RD account can be opened varies from 6 months to 120 months. The interest rate varies depending upon the bank you choose to open an account with. Next is fixed deposit account. FD or fixed deposit account is another type of account of bank account that can be opened in any public or a private sector bank. It is a one-time deposit and one-time takeaway account. Under this type of account, the account holder needs to deposit a fixed amount of sum for a fixed time period. Amount deposited in FD account can only be withdrawn at once and not in installments. Bank pay interest on the fixed deposit account. The rate of interest depends upon the amount you deposit and for the time duration of the FD. Full repayment of the amount is available before the maturity date of FD. Next type of account is a demat account. Shares and securities which can be held in electronic format constitute the demat account. The demat account can also stand for dematerialized account. There are only two depository organizations which manage this type of bank account in India. This includes National Security Depository Limited and Central Depository Services Limited. This helps facilitate easy trade of bonds and shares. It helps in conducting stress-free transaction of shares. In this type of account, the KYC is mandatory. The transaction cost is reduced. Traders can work from anywhere. The transfer of securities can be done with reduced paperwork. Now the next type of account is NRI account. To fulfill the bank requirement of the non-residential Indian or the persons of Indian origin, the option of NRI account is available. Now in this type there are three types of accounts. First is NRO, that is non-residential ordinary rupees account. This shall allows you to transfer your foreign earnings easily to India. It can be opened in the form of FD, RD, current, saving account, etc. These accounts can be opened by the individuals or jointly. Next type is a NRE, that is non-residential external rupees account. When Indian citizen moves abroad to work there, his or her account needs to be converted into NRE account. This account can be jointly opened with Indian resident. Next type is FCNR, that is foreign currency non-residential account. This type of account can be opened to manage an international currency. It can only be in the form of term deposit and can be withdrawn after the maturity period only. So this is all about the banking system in India, where we discuss the 5 most important topics about the banking system. Nowadays, some of the big companies providing a banking facility to its customers by developing applications such as Paytm, Google Pay, where they create a UPI ID for a particular person, by using which they can transfer the funds easily. Now, in the further parts of this series, we are going to discuss some of the important topics related to bank, such as the definition of a check, what are the different types of check and its functionalities, what are the different types of loans provided by the bank, what are the advantages and disadvantages of each, mobile banking, what is UPI and its functionalities, advantages and disadvantages of credit cards, debit cards, and all about the future of banking. If anyone want me to make a video on a particular topic, then you can comment me the name of a topic in the description box, and I will definitely try to make a video on this. So this is all about right now. Now I will take a leave. If you like my work, then put a like on this video and subscribe the channel for more knowledgeable videos.